Inflation has been a big topic in recent years after prices increased here in the early 2020s. But what exactly is inflation? Well, Bayesian general equilibrium theory is a microeconomic modeling approach that looks at each market for individual goods and services and how they connect across the economy as a whole. Under certain assumptions, when all markets clear and there are no sellers with inventory that they're unable to sell at market prices, and there's no buyers who are unable to purchase their desired goods at market prices, there is a unique solution to the relative prices between goods and their quantities. However, while relative prices have a unique solution, this is not necessarily the case for money prices. After all, we can denominate goods in any terms we want. Consider among currencies today, you could pay in dollars, or euros, or yen, or pounds, and different numbers would be used to represent the same values of goods and services. Likewise, across time, the value of the currency itself can change. That is, $1 does not necessarily buy the same goods across time. The price level is an index of prices, usually represented as the average price of goods in an economy. Relative prices are preserved, whether good A is $10 and B is $20, or if A is 1 and B is $2, or if A is 5 and B is $10. The price level scales these prices for the different possible levels. Inflation then represents the change in the price level. If the price level is rising, inflation is positive. This means that goods and services are costing more in terms of dollars, and so a given dollar can buy fewer goods and services. Rather than trying to capture the average price of every single good, most inflation metrics today look at the cost of a particular basket of goods and services over time, with a given year as an index. The goal in recent years has been to measure purchasing power. However, a challenge for this has been that goods change over time, and sometimes dramatically and quickly. How do we compare the purchasing power of a dollar when looking at the prices of IBM computers in the 1980s, and a desktop in the late 90s, an iPad in the early 2010s, and an iPad today? These products have changed significantly. Statisticians keeping track of these metrics use hedonic quality adjustments to try and isolate the value of product improvements from the actual change in price. But this remains a difficult problem, especially across long periods of time. But when it comes to shorter run inflation, particularly annual inflation, which is the metric most people look at, this challenge is significantly milder, though still greater than zero.